listen-only mode.
Hey everybody, Preston Bryn here with our trader user group Wkly Round-Up. This is for the trading week ending August 18th, 2017. Very interesting week, folks. I've been talking for the past 3 weeks about how the breadth of the market is getting weaker and weaker. And we're continuing to see that in some of the stats that are coming out. You know, this past week, we had another interesting ride the middle of the week, and then we finished up the week relatively flat, slightly down, but it was the second week in the row that we've been down. You know, fundamentally, underneath the market, it's fairly strong. I mean, we saw from other countries outside the U.S., we saw Japan come in at a 4% GDP, which is almost unheard of for Japan, with 20 years, 2+ decades of just going nowhere. The Eurozone came in at about 2.2%, and then we got word the end of this week that the Atlanta Fed is forecasting a possible Q3 GDP for the U.S. at amazing 3.8%. And to top it off, we get consumer sentiment is coming in relatively strong. So we've got some fundamentals there that are very good, and it's all supported, of course, by low interest rates, strong corporate profits. They're coming in at over 10% for Q2. We got a weaker dollar, which is helping overseas sales. We got low interest rates. So you may step back and say, well, hey, this is a kind of a Goldilocks scenario. Why are the markets falling? But we're getting to a point where we're a bit stretched in valuations. And I believe this pullback here, and possibly more to come, is going to be nothing more than just reevaluation of major portfolios, portfolio allocation, asset allocation across various sectors as big money shifts around a little bit. Also coming up, we got a couple of potential issues in the market. One, we got the Feds obviously coming up on 18th and 19th of September. And we saw from the Fed meeting minutes this past week, it's a split Fed. Half want to raise the rates, half don't. So it shows there's confusion with the Feds. They don't quite understand this low employment numbers, or very low unemployment numbers, and inflation still being very low. It's kind of a new phenomena for these professorial economists that don't live in the real world, but live at the podium and just in their backroom spreadsheets. So they're confused and confounded as to what can happen. So it's going to be, I think this September 19th meeting with the Feds is going to be extremely important, not only for currencies in the bond market, but for where we're going to see the equities play out. Also, we've got early next month, too, we've got the Super Mario Draghi. Now, he's driving the euro higher, which is really, in essence, pushing the dollar lower. We're going to see how that plays out. And then last but not least, we have a lot of political uncertainty here in the U.S., and we got the U.S. debt ceiling debate coming up with a deadline of October. So that's going to make, I think, a very interesting September. And October is playing out true to form as well as one of the more volatile months with everybody on vacation, so lower trading volume. So we've got a number of issues out there that can play up these markets. Now, I'm going to be I haven't done one in about a year and a half, and I've had a lot of requests to do some more. We did some Iron Condor educational videos a couple of years ago. I think it was 2, maybe even 3 years ago. And we did a number of them in Iron Condors and a few other strategies as well. So I'm going to bring them back again. I'm going to make them very inexpensive for you. We're going to, coming up, just stay tuned. We're going to do some Thursday evening webinars on Iron Condors, and then the all-important flies, and then volatility. So I'm going to be announcing that coming up in the next week or so. So just stay tuned for that, and how our group, especially our secret trader and the portfolio that I'm running, is faring. And as we did last year, we're going to beat the market. I think we're going to do fairly well. And I'll show you how to do this where you don't really need to pick a direction. There are ways to combine and use options and futures, if you can trade futures, or options in stock, to not necessarily be put into that circle where you've got to pick a winner in order to make money. So these are going to be some really interesting webinars. Like I said, I'm going to As usual for our user group, I keep prices probably 50 to 75% less than everybody else. I want them very inexpensive because I want people to play. Um, and I'm more of a player coach because I actually trade a portfolio. So you guys can see that what we do is what we do. And you'll see that sometimes textbook theory doesn't necessarily agree out with practicality in the market environment. So that's coming up. Now, getting back to the markets here for this weekly roundup, you can see what I've got on the screen here is a weekly chart of the E-mini S&P 500 futures. Now, I am at heart a technical trader. However, I use fundamentals as well. I use a combination of fundamentals and technicals to take a look at charts. And I do believe and I'll probably add this to these upcoming educational webinars, a little bit of bonus material on charting, because I don't care what option strategy you pick or just long or short stock. It doesn't really matter if you get the directional bias wrong, even if it's a sideways bias, because it is a decision. If you get it wrong, you're going to be fighting the trade right out of the bat. So I'm going to talk a little bit about that. I think every weekend I share with you some of my ideas and thoughts. And for those of you that have been following me for a while, know that we're pretty close to where the markets are going to go. You never pick the highs, or you never get on the highs or the lows, but we're usually very, very good at predicting market attributes. So looking at this chart right here, what I've got on here on this screen, and I just get rid of the lower chart for a second. I got a lot of activity on the screen, so let me just clear some of it up for you and just show a Fibonacci. Now, Fibonacci is a very powerful tool. And keep in mind that a true technicals player is not going to use any one technical to trigger a trade. They'll use a combination and a series of technicals across a series of different time frames, which you may have heard referred to as a fractal market, based on the time frame that you're trading. But looking at this weekly chart here, what I've done is I've created a Fibonacci extension. And I've shown this before, but I think it's good now to kind of just take a step back and let's take a look at it again. You can see here this high right here back in 2016, actually in July of the summer months of July 2015. And the reason why this is an important key attribute here is it took us a very long time. In fact, it was a record. I think it was over 425, 440 plus days after we made an all-time high to take that all-time high out. Over a year or so, year and a half. Because you can see over here in the summer of 2016 or 15 rather, or 16, sorry, we finally took it out, and we took it out for good back in October. But you can see these, I've defined that high point right here as a key pivot high, again, from a fractal perspective on this weekly chart, okay? So what I'm looking at here on this weekly chart, and then I defined the pivot low here in the January, February, but primarily early February 2016, when we had the pullback, which was officially in a correction. Remember, a correction is anywhere greater than 10%, but less than 20%, or at least that's the way the market heads define it. So you can define it any way you want, but it was more than 10%. In fact, the Russell actually pulled back into a bear market for a week before it finally bounced back up. This was an area where I was getting all of our folks long, not on the first drop, but the second drop, because of the way the technicals were signing up. We jumped in on the longs in February, March of 2016. So obviously that was a really nice time for us. But you can see here, I've defined that as a key pivot low, and that is a key pivot high. And then what I've done is that defines a distance, right, between that point and that point. And then we just roll that distance up like that. That's all a Fibonacci extension is. Because when you start coming up in this area here, this volume wasn't here before. This is volume over price. So you could see here, these were anticipated stop-off points as the markets move higher, okay? And each one of them, some of them turned out to be stronger resistance and or support points than others, right? And then some turn out we just blow right through them. So if we look at these, and let me just blow the chart up here just a little bit here. Let me turn off my pen so that I can actually draw on the screen here just a little bit here, or at least move it up a little bit. So let's just kind of increase the size of the screen here. for you guys at home with bad eyesight or like me, right? You need glasses, I guess. So if we move this up here, so you can see these key pivot points and these key Fibonacci extensions here. And you can see that this point at the top up here really is a 200% extension off those key pivot highs and pivot lows. So this is, although it's not at our all-time high, it's just slightly below it. That is serving as, and that is serving as a huge, huge resistance point. It's a 200% fib extension. The other major extension is the 61%, 161% extension. So really that's a 100% off the prior pivot highs if you want to look at it that way. And that's a 61% pivot off the all-time highs. And then this is another key one. And I've shown here are the key extensions off of these. And you could see where price action tends to envelop some of these areas here. That's going to be a hard nut to crack right there. I've said that to me, coming back to this area is a natural, all right, which brings us back down to the 2350 area below the 2400. 2400 is also a key area because if I were to draw a price level on there, that would be roughly at 2400. Now I'll come in on the daily chart and I'll show you, but you can see where it was resistance there and resistance here. It took almost 4 weeks to break through the 2400. And obviously anything that has a hard resistance point, when you break through it, the odds and price and action favors a retest. And we retested it again for several weeks, about 4 weeks from the breakout. And then we had that run up to the next fib level right there. So that tells me that, and we spent 4 weeks there, at this level here. In fact, the S&P this year, we had 30 record closes in the S&P this year in 2017. Yet since March, the beginning of March, the S&P is only up 1.2%. And you can see why, because this is a weekly chart, but we're just barely holding on here, right? I mean, you can see where we're sitting here, and you can see where we were in March. So it's that area there. So we haven't really gone very far since the end of Q1 of this year. We had that run up, but then boom, we're right back down again. So we're going to be at this level for a little bit until we can figure out, until price action and big money figures out just where and how they want to place their bets. I believe this pullback here is not done yet. We may have a bull rally, kind of a counter trend rally here, just a little bit, kind of a bull trap is what some people would call it. If I were to come in here and let's just take this chart down to a daily. For just 1 second. I'm going to leave the Fibonacci on, okay? And you can see here, well, right here on the daily chart, if I get it back over to where I had it before, you can see here in this daily chart, this 200% fib node, very, very strong. Now look, pay attention to the 50 EMA. You can see on this 50 EMA here, where price action, we would poke our head below it, but we would close and then the very next day open back up above. Here with that big downdraft, we had a little bit of a bull trap here. Let me just accentuate it just a little bit just to kind of show you guys what it did here. You can see in this price action right here on this chart, right here where we had this huge down move from there down to here. And then we had that bull trap right there. We could not come back up to the original highs right there. We came up, you can see we just about kissed it. And then we rolled right back over. That's a very, very bearish scenario setup, right? Very bearish. You can see this candle here. You might say, well, hey, is that this candle shows a little bit of indecision. We may have another one of these kind of things coming up like that, and then another pullback like that, taking that pivot point out there. This is a key pivot point right down in that area right there, okay? And if we look at that key pivot point in that area, that was the one I pointed out on the weekly chart. That's right at 2400. All right. So I'm not surprised. In fact, our trades and what we're doing is, you know, that would be a very anticipated move in my mind for the markets. Now, should we break that? And generally, the markets, as you know, always overshoot and undershoot. They overcorrect, they undercorrect. There's kind of like a pendulum. So we could swing through it, and then that'll establish another key pivot low. Should we break that area right here? And should we break it, then if we pendulum down and then come back up and test the 2400 again, assuming we get down there, then what I'm going to be watching for is another series of key price maneuvers to determine, is the 2400 going to hold, and then we're going to just chop around between this area here and this area here until we get through the Feds and we get an idea of what the heck they're going to do. Um, and Yellen, as we finally call, AKA Aunt B, is she going to serve up a really sugar-laden blueberry pie and give us her recipe for a lot of sugar and butter and fat and lard, or is it going to be very tart, meaning she's going to come in more hawkish? I don't know, but I do know what I see, and what I see is a price action that shows that we should be in touch for some more weakness. Okay, so, but as I said earlier, the fundamentals are sound in the market. I just think this is more of a shift from some of the growth stocks to more value-oriented stocks, a little bit of allocation away from, say, technology and cyclicals into maybe utilities and staples and some of these others here. Now, if I put on my other support elements here, now you can see these key price levels that I'm showing here that I talked to my members about that we're looking at. And these are key price levels that we can just see this thing going down and down. Now, as I go back out in time, and let's go back until the beginning of this year. So we'll just look at 2017. So you can see with 2017, and another tool that a lot of people really don't use, which surprises me, it's just one of them, is right over here where you can see the buyers versus sellers. This is volume of price at each different price level. So we've got a huge amount of in this case, overhead supply, where it looks like the sellers won out right here. So selling won here. Right here, the buyers have won in the prior fight. So and you can see we're right in that fight right there where the peak of the volume is. So this was a big fight going back to June and July, and then in July the buyers won and took the markets up to our fib node right up here. But now the selling overtook the buyers here. So it just took it right back down here where the buyers, it just slapped it back down again. So we're going to watch this very closely. Should it break, you'll see here there's very little volume in this area right here, very little volume. So there's not a lot of buying versus selling lurking here, which would suggest that it could take us down to the 2400 very quickly. And then it would put us into this really wide zone right here where, you know, there's a lot of general buying and selling going on, and they're duking it out right here. So I don't believe we'll go much deeper than this pullback right to the let's say the base of this area here. Okay, now if I had to define that in percentage terms, and this is assuming we do not have any geopolitical risk like tensions on North Korea or any other unknown, if just assuming things continue the way they are, just a natural state of things, that would be what I would assume. So if I were to just come in here and define off of the highs here, let me pick this here and just go take a look at it and see off the highs from that fib node pullback, it would take us down to roughly, let's get in the line straight here, roughly around 2352. Notice that is almost, again, that's about a 5.48% pullback. Remember, I call a correction, or I don't, it's the market's defined a correction as greater than 10%. I call anything between 5% and 10% a pullback. And anything less than 5%, a minor dip. All right, so you got a dip less than 5%, and these are my definitions, and I don't care what you call it, but that's what I label it, just so that people understand in my mind when I say a dip or a pullback or a correction. So a dip is less than 5%. Pullback is 5 to 10%, and then a correction is greater than 10%. A bear market starts at 30% or 20%, and then officially you can call a market crash greater than 30%. But I will tell you, every time we've had a bear market, the average is 35%, at least over the past ones that we've seen in the S&P. So pulling back to this 50% extension node off the prior pivot highs and lows makes for what I would believe would be a very common area for the markets to be. And you could see it would put us right in this thick zone right here. Now, how long would it take us to get there? I'm not really estimating that. I could come in here and do some Fibonacci time series as well as Gann series, but I'm not going to do it here on this session. But let's just say that um, I'm looking at the end of August going into September timeframe. I don't think the markets are going to come unglued. Excuse me. I don't think the markets are going to come unglued prior to Yellen speaking. We've also seen volatility work its magic as well. If we come in and we look at vol in here like this, you can come in here and you can see the VIX is elevated. It's up to 14.26. You can see these jagged moves here. And it's really unusual to get a move high all the way back down to the 11, back up to 16 again. That's unusual. Normally you have it pull back and stay back for a couple of weeks and then it bounces again. So that just shows you that the nature of the market right now is very, it's a little bit erratic. But you can see here that I would not be surprised to see us get back up here again, back into the low 20s if we get that over 5% pullback, okay? 5.5%, somewhere in that area there, bringing us back to the 50% extension node of the prior pivot high formed in 2015, the summer of 2015, and the prior pivot low formed in February 2016. So those are just some of the things that I'm looking at here. The other thing is, let's take a look at the bond market. Bond is a flight to safety. I was telling our members that you've got to be cognizant of where big money is going. Whether you agree with the big money or not, it doesn't really matter. Big money is going to move the markets, and I've been telling our members now for about 4 weeks. In fact, starting in March of this year, late February, early March, we started pulling back and adjusting our my portfolio that members can follow me on, so that we've been more into a safe haven asset, gone a little bit more to cash, and we've taken away a lot of our directional plays and gone more sideways market. And some of our anchor trades are always like that. From the options perspective and futures perspective. But as you can see here, the bond market really kicking off the year here in January at 150.07. I mean, that's kind of how the bond market kicked itself off, and we're sitting up here near the 2017 highs. Remember, on September 19th, we're going to get an idea what the Feds are going to be doing with the balance sheet reduction. I call it the BS reduction. Or we're going to get the BS strategy out of Yellen, aka Aunt B. So we'll see what her BS strategy is going to be. They've got no choice. I think they're going to start reducing the balance sheet. Now, what does that mean to you as a trader? What that means is it's not going to really affect much on the short-term rates, treasuries less than 10 years. But the 30-year, it's going to tend to move the 30-year lower and interest rates higher. If the Feds hike the rates, you'll see the short-term, the 2-year and the 5-year move on a percentage basis greater than the 30-year. But you'll see the balance sheet effects affect the 30-year further out in the yield curve in term than you would say the interest rate hikes. So I believe that, and you can see here a lot of this movement into the bond market right now is just simply based on the fact that the markets are a little bit fearful, and that's just kind of a safe haven asset for money right now. And then, of course, if we look at currencies, I was having people get into the yen. I was talking about the yen as another safe haven asset. And I've been talking about this now. You can see the money flowing into the yen. Keep in mind the yen moves generally opposite of the Nikkei. And when the yen is moving stronger, the Nikkei is falling. And you can see the yen now is at a key inflection point. And if you ever want to get into safe haven assets, in the equity world, think utilities and staples, XLP and XLU as an ETF. And if you ever want to get into a safe haven currency, think of the yen. Now, of course, the Swiss franc as well, and the US dollar to some extent, but I believe the yen is better positioned as a safe haven asset than just about any of them. And FXY is the ETF that tracks the yen. So we had members jumping into FXY, and our suggestion was to sell puts underneath FXY. And you can see here that it's been a successful trade. And we've had it's a about an $88 stock. So some people will just pick up, some shares. Others will go deep in the money calls. Others will sell puts. It depends on what your proclivity is for hedging your portfolio. We've got a number of different ways to do that. And we're going to cover that when we get into our volatility series here coming up, in the next 30 or 40 days. But anyway, you can see this is a risk-off area, okay? And the dollar has just been crucified. It's attempting a rally. You can see this channel here that the dollar has been in. And if you look at it, right at the top up here is right at the beginning of 2017. And then we've just been in this channel right here straight down. Now, I want you to think about this for a minute. If we look at the day that Trump won the election, right? There was this reflation trade idea. And let me just mark it on the chart right here with the dollar in the overnight action right there. In this area here, the dollar was at 90, the dollar index was at 95.90 right here. And then you can see the dollar really shot up to 103 in literally a month and a half. This was right at the end of December of 2016. And the whole concept behind this move was that Trump was going to repatriate money from corporations. They were going to bring the money back here. They were going to buy stock. They were going to pay more dividends. They were going to invest in plant and equipment. He was going to loosen regulations. He was going to do infrastructure spending. He was going to jack up the stock market with less regulations, on and on and on. So the market was making a bet that that's what was going to happen. And no sooner did he get into office, right? Then the market started to say, all right, let's take some profits. This was a little bit of profit taking. And then moving up to when he was inaugurated, then boom, you can see the dollar peaked. And then all of a sudden, the money started shifting its bet. Big money was shifting the bet that, well, maybe he's not going to be able to get this done because he's going to be fought in Congress and Senate by these knucklehead politicians. I believe they're all idiots, but that's for another debate and another day. But you can see the dollar has just been in this tail swoon all the way down. Now, in a strange Machiavellian sort of way, it's helped corporate profits. But surprisingly, commodities haven't caught on as much as you would expect. Some have, but many haven't. And now the dollar is just attempting what I would say is a feeble, and I mean a feeble counter trend move. I think the dollar is going to roll back over again, come back down, and the only thing that's going to save the dollar is going to be Super Mario Draghi. And the reason why I say that is Draghi's faced with a task now, because if we look at the strong euro is starting to hurt exports of Europe and ECB countries. And you can see the euro here has just been, what can I say? Well, let's get it back over here again so I can say it. Here's the euro right here. And you can see the euro at 2017 highs, and it's just backed off a little bit, but it's at 117. Back when the euro almost hit my target at 102 in the earlier part of the year, and it opened the year at 105. And then I said the euro is going to move up to 114, 113, 114. And it came right up to my area of 113 and hung out here for quite some time. I mean, literally, it took from May to June, about 5 weeks to finally bust through that key 113 area, and then it just took off, and the dollar just fell off the table. But this is going to begin to start to impact corporate profits over in Europe, and Super Mario doesn't want that. And he's faced with a tough dilemma now. As inflation starts to come back into Europe, it's still low at 1.3% as it is here. I think he's going to try and talk the euro down a bit. So I think we're going to see a little bit more of a counter trend move in the euro, which would mean to the downside, possibly down to the 50 EMA. And I think you're going to see a counter trend move in the dollar, still up a little bit, because I guarantee you those two are on the phone talking with each other, just trying to figure out what the heck they're going to do here. And then, of course, if we come in and we look at the other one that's really been on the move here is gold. And I said gold has got to clear 1,300 before I'm a believer. And you can see here, gold had an intraday move. It actually cleared 1,300, or it actually went up to 1306, but it pulled back and it closed and settled below here. So the high price is a little bit higher than what I've got shown here. Let me just mark the new high price for this year. And you could see here as I just move this up. I don't want that. Come on. Let's get it back here. Let's highlight it. And then if I move this up right there, that's the new high price. 1306, I think 80 roughly. All right. So let me just take this off the screen because that's going to become our new resistance point, 1306.90. And then I'm going to just lower this just a little bit because that seems to be a kind of a favorite stopping off point right there. So you can see until the euro can clear this with conviction, then I'm not going to be that interested. If we look at volume, look at the volume down here, guys. That was a conviction move. On my volume, what I like to do is just like on charts, but on volume, I use a 5 and a 20 EMA. The purple line is the 5 EMA, the blue line is the 20. So when the 5 crosses the 20, more volume is coming into the asset in question, in this case, gold. You can see here for a lot of the rally here with gold, the 5 was below the 20 EMA and getting lower and lower. So volume, there was not a lot of conviction here in this move. I think it was more of a technical rally than anything else. Then we had this pullback, but then all of a sudden, we had a lot of money come into gold when the North Korean crisis mounted up. And we've got these issues with the political chaos going on in DC. So now the question is going to be, with this big reversal candle right here, up and then back down, is gold going to be able to hold this, or is volume going to fall back off the table again? So I'm still not convinced with gold. And let me tell you, if Yellen does come out hawkish, or at least indicate that they are still on track to hike the rates this year, then you're going to see gold come back down to the 1250, 1260 area, because gold hates high interest rates. Now, it loves a cheap dollar, but it hates high interest rates. And right now, inflation is off the table. So I'm not convinced just yet of where gold is hanging out. Now, if we come in here and we look at oil, oil had a strong finish on Friday. I mean, if you look at this, oil is coming on. Let me just first back out just a little bit here. Let's just back out. And you can see here this downsloping channel right in this area here, right in February. And we've just been making lower highs. And you can see the fight. I mean, just a huge battle going on fighting this channel. Now, you can see down below, we've got a lot of money coming into oil right now. A lot of volume coming into oil on this up move here. Tremendous amount of volume. And you can see on Friday, this huge move here is taking us right back up to a key resistance point. 50 is a psychological barrier for oil. It's always been this way. Any number that ends in a 0, 40, 50, 60, 70, they're psychological barriers. Now, we're in our 14th trade. We've had 14 trades in a row of winners the way we're trading oil right now. 14. And it's unusual. Normally you expect to win 7 out of 10. You manage your risk on the 3 and you net up a nice return. But we haven't had a losing hit yet. And I don't think I'm jinxing it here, but let's see where oil is going to go. You can see this big reversal here. I mean, we moved from 46.45 all the way up to 48.71, a $2 move. If we look at it on a 2-hour chart, that's an insane move. I mean, we literally just flipped the switch. Now, what caused that? Well, a big thing that caused this, and you can see here, not as much volume on this move right here on this 2-hour chart. But what caused it was when Baker Hughes came out and reported less rigs available. And what the oil market is counting on, what Saudi Arabia is counting on, is that they're slowly bleeding off these inventory, this massive overabundance of inventory. And we've had, I think, 6 weeks in a row where the drawdown has continued to go lower. But where the eyes haven't been focused in the oil market is on demand. Everybody focuses on supply. We look at both. And they've got to match up, because if supply is going down, but then demand is going down at the same percentage rate, then it doesn't make a hill of beans, right? And that's what we've seen. So I still am not, I'm not going to become a believer in oil unless or until we can clear a prior pivot high. And the prior pivot high, in my mind, is sitting right at this key level right here. All right, let me just mark it on the screen. Right at 50.43. So 50 is the psychological barrier, but if we can clear that, and we've got ample volume behind it, and it's sort of supported by our other indicators and the market fundamentals of oil with inventory demand versus supply, then we'll change our strategy. But right now, we've been able to manage the vast movement in oil, both these up and down moves, quite nicely with the strategy that we've been using to trade the oil market. So we'll see if this, and we haven't had a move like this in quite some time. The last time we had it was back on July 25th. You can see here a very similar move, and then oil continued to move higher for about 4 days, and then it settled in and then gave it all back up again. So I want to see if we get follow through here on this one. Okay. And it also, by the way, regained the 50 EMA. So these are just, I mean, the 200 EMA. So these are really important things I'm watching for in the oil market. All right, everybody, that's pretty much my update for the weekend. We've got a number of things that our members for this Sunday night we're going to go through. We're going to look at the NASDAQ. We're going to look at the Russell. We're going to take a look at some key other charts that will help us look at the breadth and depth of the market, and a few other things that are members only that we're going to be covering. If you are not a member, highly encourage you to come in. If you're a member, then you'll be able to get in and see some of the things that we're doing, and you'll see why we're usually on the right side of the path as far as the markets go. Otherwise, everybody, make it a great weekend. Members, I'll see you tomorrow night during our session. Take care, folks. Ciao now.